Hello everyone and welcome to today's webinar. I will be your moderator. I'm Antonella Vona. I am the External Region Director for Mediterranean and Africa. I'm glad to see many diverse attendees today, and we are glad as Coface to support you with our economic update and publication. In this really unprecedented situation from a sanitary and economic point of view. First of all, thank you for joining us. I'm pleased now to introduce our speaker today. We have Marcos Carias, Coface Economist for Eurozone, and Seltem Iyigun, Coface Economist for Middle East and Turkey. Unfortunately, Mr. Tufan Gomert can join us. I will hope next time. He has really urgency, and I will give now the floor to Seltem. Before that, I just would like to remind you that there will be a record version of this webinar, so it will be available. And you will have at the end of the presentation a session of Q&A. You can submit any question every time via portal. So please feel free to send it through the system. So without any further ado, I leave the floor to Seltem. Please go ahead.
Yes, thank you so much, Antonella, and thank you so much to all participants. Thank you for your time. I will start briefly my presentation on the global economy and Coface's perspectives about the global economy. Then I will follow up with our perspectives on the Middle East and Turkey region. So as you know, the number of coronavirus cases reached 123 million around the world as of yesterday, while the death toll reached 2.8 million people. The largest numbers are in the US, followed by Brazil and India. And total vaccination is increasing as well. Total number of vaccination doses administered per 100 people in the total population rose to 5.75 in the world as of mid-March, compared with 1.75 early in February. The number of doses administered for 100 people in the total population stood at 112.5 for Israel, highest in the world, followed by 74 in the United Arab Emirates. So the divergence of the pace of vaccination pace among these countries represents an important factor for us while determining risk assessments, as it determines how fast things can go back to normal in a country. In this sense, the larger number of available drugs and vaccines will be, faster the economies will be recovering. Our forecast for global growth in 2021 rose to 5.1% from around 4% between the last quarter of 2020 and the first quarter of 2021, thanks to the strong recovery in some developed countries and a quick vaccination process in some other countries. Our key assumption is that the main major economies will manage to vaccinate at least 60% of their population. But it masks several changes at a country level. For the US, we revised our 2021 growth forecast upward to 5.7% from 3.2% previously, on the back of the larger than expected $1.9 trillion stimulus package and the US central bank signals about maintaining the loose monetary policy in place for some time. We are also more bullish on the Eurozone growth that we expect at 4.5% versus 4.3% previously. On Russia, 3.6% versus 3.2% previously, and Italy, 5.3% versus 4.2% previously, but we are mostly flat in our growth forecast in the MENA region at 3.1%. With this recovery, Global production should return to its pre-crisis level by the end of 2021. However, this performance will owe much to a favorable base effect, linked to the fact that the level of activity at the end of 2020 had already recovered some of the ground lost during last year. The world trade would increase by 6.7% in volume after declining by 5.2% in 2020. These estimates are subject to a high degree of uncertainty since they depend on the evolution of the pandemic and the government responses to it. As for the corporate insolvencies, they declined in all regions in 2020, like minus 22% in the Eurozone, minus 19% in Asia Pacific, and minus 3% in North America, thanks to government support plans, of which the continuity will condition the survival of many companies this year. Without them, Coface estimates that the number of insolvencies would have increased by 36% globally last year versus an observed decline of 12%. Now we're going to continue with our perspectives on the Middle East and Turkey region. While the number of daily cases is increasing, except in Israel and the United Arab Emirates, for Turkey, the daily cases increased about 12,000 people compared with 10,000 at the beginning of the year. However, for the United Arab Emirates and Israel, the daily number of cases declined from around 6,000 people to around 1,000. Israel's vaccination drive is continuing apace, with more than half of the population having had their first dose of the COVID-19 vaccine and 46% of the population receiving their second dose. Nearly 60% of Israel's 9 million residents have gotten at least one shot of the COVID vaccine. And today, as I said previously, Israel is the worldwide leader in vaccinations per capita at 112 doses administered for every 100 per people. The second country having the highest speed of vaccination is the United Arab Emirates. The authorities have administered the COVID-19 vaccine to over 56% of the population. The rise in oil prices and the return to normal of the economic activity in line with the vaccination efforts sustain the economic recovery in the Middle East region, particularly in the large countries like Saudi Arabia and the United Arab Emirates. We expect oil prices to average around $60 per barrel in 2021. The Saudi authorities have decided to voluntarily reduce oil output by 1 million barrels per day in February and March, and its production stood at 88 million barrels per day in February. With oil accounting for around 40% of the country's GDP, we expect this to have a significant drag on the headline growth rate. On the non-oil side, continued fiscal consolidation will slow the recovery in investment and consumption. Specifically, the July 2020 tripling of VAT from 5 to 15% has increased inflation that would limit domestic purchasing power and sentiment. Meanwhile, we know that the government plans to cut total spending by around 7% this year, and this shows that the capital expenditure will decline. So there would be a limited increase in public sector wages and benefits. On the United Arab Emirates side, the quicker than expected vaccination process sustained growth performance. This in turn will accelerate the removal of the corona-related sanctions and the normalization of the business activity. Still, the recovery, we expect it to be gradual. The latest PMI data indicated that there are some new disruptions to the UAE non-oil private sector because of the tightening of COVID-related restrictions, which pushed new orders down and hampered consumer sales. In Israel, thanks to the quick vaccination, as I previously mentioned, the return to business as usual is expected to happen faster compared with the rest of the world, and the country will be able to open fully in the near term. Additionally, external demand will offer further support to headline growth, as economic activity in Israel's trade partners will begin to pick up in the first half of this year. In particular, growth in the Eurozone, the United States, and China will boost demand for Israeli goods and services. Other countries like Bahrain and Oman, growth is also expected to come back, but external vulnerabilities will remain in place. The Omani economy's recovery this year is expected to be weak because of energy prices that are below the country's fiscal break-even point, estimated at $110 as per the IMF. And we also expect tourism revenues to stay low. For Bahrain, the country's fiscal break-even price also stands below the current spot oil prices at $83. The country is expected to post a positive growth rate this year, although the pace of the recovery is expected to remain slow. Though aluminium production is expected to inch up this year by 1% from a year earlier, in line with the recovery of Chinese demand and rebound in metal prices. For Kuwait and Qatar, after recording a sharp contraction last year, the Kuwaiti economy is expected to slightly recover this year, thanks to the supportive base effect, higher oil prices, and looser OPEC Plus oil production cuts. The oil sector's improvements will be vital to bring growth back into positive territory, as it accounts for nearly 40% of GDP. And the Qatari economy also is expected to record a gradual rebound this year, driven again by a recovery in energy prices, led by the economic recovery in Asia. Also, we expect the country's LNG exports to increase by 5% this year. Well, we know that the virus situation and the vaccination affect the economy mostly through the mobility channel. Google mobility data shows that it held up relatively better over the last several months compared to the big decline last year. Governments actually have learned how to introduce measures and take targeted actions in order to keep the economic activity continued. But the activity is still below the normal levels, and this actually provides a potential for growth. This is important for our growth forecasts, and we expect the gradual normalization to continue in the rest of 2021. On the other hand, fiscal consolidation will remain in place. We know that the government in the GCC has been pressured due to the falling oil prices and high fiscal spending due to the COVID-19 conditions. And this pushed, for example, Saudi Arabia to triple the VAT even during the pandemic to protect the government balance sheet. The non-oil primary balance is expected to improve as a result of the economic recovery, easing of coronavirus measures, and recovering private sector spending. But the risks persist. Most of the GCC countries are set to produce a double-digit or near to double-digit fiscal deficit to GDP ratios in 2021, namely Bahrain, Oman, Saudi Arabia, and the United Arab Emirates. Although we expect an improvement this year thanks to the fiscal consolidation and a recovery in oil prices, the level of deficits will continue to remain quite large. And fiscal deficits have their reflections in fiscal break even oil prices, which are close or above $65 for Saudi Arabia, for United Arab Emirates, Kuwait, Bahrain, and Oman. Only Qatar's break-even oil price level remains below that level, close to $40, which is below than the level of the other countries. As a result of this continuous deficit, GCC countries will remain active on the capital markets. The total international debt issued by Saudi Arabia, the United Arab Emirates, Qatar, Bahrain, and Oman stood at $42 billion last year, which was 25% up from the level in 2019. Although 2020 was an exceptional year and deficits will slightly be better this year, the need for borrowing remains, and the countries in the region will continue to issue bonds this year. Higher debt to GDP ratios in the region generally do not pose a major default risk, as the balance sheets are quite strong, but there are some concerns over Bahrain and Oman, as they have large budget deficits and highest level of public debt to GDP ratio across the region. Well, Turkish economy grew 5.9% in the fourth quarter of 2020 from a year earlier, while it grew 1.8% in 2020 again as a whole, making Turkey one of the two countries with China that posted a positive growth rate among all G20 countries. The industrial production rose 2.2% last year on a yearly basis. Automotive, chemicals, ICT, agri-food have been among the sectors that have been able to post some recovering towards the end of the year. We saw the capacity utilization coming back to close to 70-75% level for most of the sectors since May 2020. We see the same tendency as the business confidence index. Expectations of exports for the next 3 months rose around 30 points to 117. All in all, Turkey's economic outlook seems to be more balanced as policymakers try to balance the sharp expansion in credit growth and inflation while not stifling the economic recovery. Inflation will be among one of the key problems, though, in Turkey. We will see it in the next slide. Well, all in all, we can say that the recovering external demand and base effects should help headline growth to increase in 2021 in Turkey. On the other hand, we expect the retail sector and services to continue to struggle this year during the lockdown periods. Businesses in those sectors have lost an important part of their turnover, and it would be almost impossible for them to compensate those losses during the rest of the year. As a result, they are expected to operate with a lack of weakened equity capital and low profit margins. Additionally, the rise in interest rates on loans creates a burden of higher financing costs for those companies. The other very important vulnerability of the Turkish economy relates to high inflation and the uncertain monetary policy framework. Last year's currency shock has created an important inflation stock for 2021. We were expecting the yearly average inflation rate to stand at 13.4% at the end of 2021. However, with the recent changes in the central bank's leadership over the last weekend, we see now upward risks on our forecast. Indeed, Turkey's central bank chief has been abruptly sacked on Saturday, 2 days after a sharp interest rate hike to head off inflation. After that decision, the lira plunged 15% to near its all-time low, hitting 8.48 versus dollar. The country's 5-year CDS rose 160 points, and the 10-year benchmark bond yield rose 400 basis points. Although the new governor's commitment to lower the inflation and transparency is assuring for the markets, his lower stance poses questions about the way and instruments to be used to achieve this goal. The return to last year's complex monetary policy tools, such as the use of several monetary policy rates, would put further downward pressures on Turkish assets. At this stage, Turkey's high inflation and macroeconomic vulnerabilities, in our view, do not leave a large room of maneuver to the central bank to cut its policy rate. The next meeting is scheduled on April 15th. For now, we will maintain our 2021 forecast for the Turkish economy and closely monitor data and further guidance from the authorities. Israel's GDP contracted 2.4% last year, helped by the global economic recovery and gradually rising trade volumes in 2021. Israel's economy is expected to recover from the contraction of last year, although in a progressive way. The pre-COVID-19 production level should be achieved only after 2021. The composite state of the economy index fell moderately in January, particularly reflecting the impact of the third economic shutdown starting on January 8. On the other hand, the shutdown weighed also on the credit card purchases in January, which were down by 16% compared with a month earlier and 8.8% compared with a year ago. Manufactured goods category like the furnitures and electronic and electric goods, as well as clothing and shoes, have been the sectors that have been affected the most negatively by the lockdowns. As long as the exit process from the third economic shutdown will continue, a return to the economic activity will occur gradually. We can say that 30% of exports of Israel are towards the United States and the rest mostly to Europe and Central Asia. Consequently, the pace of recovery in those economies will be determined for Israel's exports and their contribution to growth. On the other hand, Israel has signed normalization agreements with the United Arab Emirates and Bahrain late in 2020, which is expected to provide important trade and investment opportunities to the country. The deal would allow Israel to find new markets for its especially high-tech products, food products, and attract tourism flows and key investments. And most of these investments are expected to happen in the pharmaceuticals, chemicals, and security areas. The deal may also enable Israel to access energy at a discounted price. Well, last year we saw that the state budget deficit amounted to 12% of GDP, compared with an annual average of close to 3% over the preceding decade. We know that the bulk of the increase in deficit originated from the expenditure side. Despite the expected rise in the revenues, thanks to the economic recovery, the deficit is set to remain wide. The political uncertainties create an obstacle for the introduction of measures aimed at countering the fiscal deficit, and therefore expenditures should remain high. But the termination of the stimulus package, initially that was about 6% of GDP, would help the government to reduce the budget deficit. Still, the debt level of the country will remain at manageable levels. The international reserves of Israel are very strong. The central bank continues to buy shekel in order to prevent further appreciation of the local currency. And in the period ahead, the tax collection is expected to recover in line with economic growth. And the narrowing of the budget deficit will also help to keep the debt at manageable level. And this is a slide of our last quarter risk assessment on the sectors. You can see that we are getting progressively more optimistic about in terms of our sector risk assessments. We have in the last quarter of 2020 improved our sector risk assessment in Israel ICT sectors, as well as in the automotive and chemical sector in Turkey. As long as the easing of the coronavirus-related sanctions happens and the economies and the business activities go back to normal, we consider that we would have further room to better assess the risks in those sectors, and the outlook of the risk would be improved, of course. Well, in general, except the sectors for which we changed the risk assessment outlook, the situation currently stands quite stable. But we monitor closely the recent developments in terms of political risks, the currency risk, and also the payment risks. There are some sectors which are profiting from the pandemic conditions, such as chemicals, ICTs, agri-foods, but we also see some recovering situation in the automotive sector, paper, but other sectors like the construction, energy, and textile clothing continue to suffer from the current health situation. So I'm going to stop here. Thank you again for your time and attention, and I'm going to leave the floor to my colleague, Marcus. Thank you so much.
Thank you, Seltem.
Thank you so very much. So, just wait a little bit. Antonella, can you see my screen with the notes or without the notes?
Yeah, without notes, it's okay.
Without
You
notes,
can go.
okay, we're good.
Thank you very much.
We're good. Okay. So we're going to shift from a region that is doing a little bit less well in terms of vaccination outlooks, certainly less well than Israel, which is Europe. And of course, this is going to have consequences for economic activity, namely in countries like those of Southern Europe, where the economies are disproportionately dependent on the tourism sector and tourism activity. Nevertheless, not everything is bad, and notably, we are seeing a strong recovery in the manufacturing sector in the end of 2020 and the beginning of 2021. So this is why we have like this kind of divergent dynamic in the European economies. Let's see how this looks in the data. So, like I said, when we look at confidence indicators, and what I'm charting here is the European Commission Confidence Index, an indicator that is roughly similar to the better known PMI. What this tells you is that in the manufacturing sector, both in Spain and Italy, well, in the past few months and the beginning of 2021, the situation in terms of activity is back to normal, basically back to the levels where it was at the end of 2019, and in the case of Italy, even a little bit better. The situation is very different in services, where of course all the still prevailing mobility restrictions make it so that activity really cannot go back to normal, and we see this in this green line here that we can see is still very far away from the pre-pandemic levels. So there is the good news in this, and for the good news for the tourism sector and for other services sector is that, well, the public support, the government support that has very much kept these sectors alive, like an artificial lung during the past, during really the whole of the pandemic, still in the beginning of 2021 is remaining relatively robust. We have seen both in Italy and in Spain recently very robust public aid packages being passed. 7 billion in grants for Spain, 11 billion in Italy. So for the moment, in terms of corporate solvency, in terms of payment delays, we still see the situation remaining positively stable during this first half of 2021. Maybe the difficulties will start coming more in the second half and in the start of 2022, where aid will probably start becoming more selective, where the government will start worrying a little bit more about not supporting zombie companies, and especially in the beginning of 2022, when the pressures, the financial pressures from things like the all the guaranteed loans that have been key in supporting firms in Southern Europe will start being felt. So at the aggregate scale, this diverging recovery is translating into pretty healthy growth rates for GDP at the start of 2021. So these growth rates that are mainly the reflection of the recovery in the manufacturing sector. All signs point to this recovery being pretty robust in the first half of 2021, and these growth forecasts that I'm showing you for Spain and Italy translate a certain prudence about, well, are we going to see this be the case for the entirety of 2021? And we actually expect this to progressively this rebound in manufacturing stifle out a little bit in the second half of 2021. Conversely, in the tourism, in the services sector, the situation will start to improve, but pretty gradually. Notably, during the summer months, we certainly expect things to be a lot better compared to last year, but still have a performance that is at best 90-95% of what you have in a regular year, mainly because, it is likely that many restrictions will remain, especially at the intercontinental travel. At the level of the intercontinental travel, we will be starting to see the beginning of what is the post-pandemic world, but we will not be entirely there yet. So, in terms of the convergence to regular levels of GDP, we expect to end the year around 95, 96, 97% of 2019 levels of performance, and reach this normal 2019 level of economic performance somewhere towards mid 2022 if things continue to go well. Of course, this is all subjected to any changes that we might see in, for instance, the vaccination campaign going slower than usual, or some new variant in the coronavirus disease, and all these kinds of uncertainties. So, shifting a little bit to the corporate solvency perspective, well, we had these trends in 2021 that were really paradoxical when we look at the insolvency numbers, of having unprecedented GDP contractions at the same time as having unprecedented contractions in the number of insolvencies. Normally, we expect corporate insolvencies to increase when GDP contracts, but this was not at all the case. And the main explanation here is, of course, the very, very robust forms of government aid that I'm sure you're all familiar with, temporary suspensions of working hours, that what we know as furlough schemes, the guaranteed loans that I was talking about, tax deferrals, many ways in which the state has supported businesses in a way that it has never done before. Nonetheless, towards the start of 2020, we do see certain pockets of the economy start to show increases in corporate insolvencies. So we are looking here at the case of Spain, where even though insolvencies in the aggregate decreased by 14.5% in 2020, there are certain sectors of the economy where this was not the case, and as I'm sure will surprise nobody, this is mainly the case for the services sector, particularly tourism, and a category that we know as administrative services, where we have a lot of low added value services to businesses, such as agencies that manage short-term contracts, businesses that provide office services like cleaning and things like this. in these categories, we're actually, especially towards the end of 2020, seeing year-on-year increases in insolvencies. And it's important to note that this is happening while the suspension of the obligation to file for insolvency is still in place in Spain. And in fact, this suspension was recently renewed until the end of 2021. Why is this important? Because this means that what we are seeing here are, so to say, voluntary insolvencies, businesses that are kind of throwing in the towel, so to speak, even though the law does not force them to file for insolvency, even if they are not paying their financial commitments. To a lesser extent, we see a similar pattern in some sectors, in some pockets of the economy in Italy. Here, the decrease in insolvencies during 2020 was even stronger than in Spain. Nevertheless, we do see in Q4 again this pattern emerging where insolvencies are kind of catching up in some categories. Most notably, I think, is this 12% increase, year-on-year increase in the transport sector. So I think that this is the pattern that we can expect to continue seeing during the next few months, next few quarters, of insolvencies progressively catching up. And what I think this translates is that even though we can know that a lot of companies were saved, there is a lot of also hiding of difficult financial situation of companies by this government support, and we can expect in the next few years, in 2021 and 2022, for these pockets of vulnerability to become apparent. So this is why we have some elements of prudence in our outlook, even if undoubtedly activity figures are becoming a lot better, because we haven't really seen in terms of insolvencies the effects of what happened in 2020. So what we wanted to do, and this is the contents of a paper that we published a week ago on corporate insolvencies, and that what we will start promoting, where what we did basically is ask ourselves, okay, we had a unprecedented economic crisis, we have had unprecedented help for businesses. What is the net effect? What is the net effect? Can it be possible that all these insolvency contractions in insolvency numbers are actually what we are seeing, that the government has saved so many companies? What we did is basically do simulations in which we try to ask ourselves, well, when we look at government help, by how much should we have expected insolvencies to grow? And look at the difference between that and the actual insolvency numbers that we had in 2020, and see how many insolvencies we could expect, how many insolvencies are actually being hidden. This is what I'm going to be explaining in this slide right here. Let's take it slowly. So what you have here in the blue bar is the actual insolvencies numbers, the growth or more the contraction in year-on-year insolvencies by sector that we had in 2020. And what you have here in the green bar is the results for simulation, meaning the growth in 2020 insolvencies that we think we should have seen, even when we take into account government measures, and specifically measures like furlough that we know helped reduce a lot of cost for companies, and guaranteed loans that we know increase the liquidity of companies. What you have here in the orange bar is the difference between the two, meaning that we take what we think we should have seen in terms of insolvency growth, we subtract what we actually saw, and we get this stock of what we call hidden insolvencies, meaning insolvencies that have only been postponed due to government help but have not been avoided, and that we think we should see uh, during this year and maybe next year, depending on how much the government continues to support the liquidity of these firms. Now, I should mention that these estimates that we have here, we are the result of the model as we ran it before the recent aid, the recent packages that were passed in the past few weeks in Spain and Italy. And so we don't know exactly sector by sector what the allocation of that aid will be. Therefore, we could not integrate it into the simulations. We can imagine that the overall insolvency numbers will maybe be a little bit, a little bit a little bit lower, but still that doesn't change the overall picture that we think that there are hidden insolvencies that we um, that we are yet to see manifest. Here are the results for Italy, where notably we saw a lot less growth here in the tourism sector of insolvencies. I mean, actually, tourism insolvencies contracted in 2020, and so we expect at some point a substantial rise in insolvencies here as well. But it is also important to note that what remains very uncertain and what we unfortunately cannot apprehend with this sort of model is, well, how fast will these insolvencies come? Like I said, this depends a lot on how much governments continue to support companies. And even though we do have these important stimulus packages passed in the beginning of 2021, we have to notice that the tone is starting to change a little bit. They are signaling, the governments are signaling that in the future, aid will have to be more targeted, as opposed to the mostly indiscriminate and very general approach to aid that we saw in 2020. And especially authorities like the Bank of Spain, like the Bank of Italy, are warning about the danger of zombification, the danger of zombie companies, the fact that there are many companies that are in poor financial health that they wouldn't like to see being supported indefinitely, and that especially it is necessary to do important reforms to the insolvency code so as to clean up the corporate sector. So on the basis of these considerations, we are mainly thinking about two scenarios for the future of insolvencies, of these hidden insolvencies that we are talking about. And this is what I illustrate in this chart. So there will be one scenario in which we see what would look like a wave of insolvencies, in which these troubled companies are dealt with relatively quickly over 2021, especially 2022. Where after the expiration of the insolvency moratorium, especially in Q1 2022, we see a lot of these troubled companies managed, preferably through more restructuring of debt and less liquidation, and then the rhythm of insolvencies can decrease, and therefore in a way that is more favorable to the productivity of the country, in a way that allows workers and capital to be allocated to more productive and more future rich sectors of the economy. But you can also see a scenario, a more zombification scenario, where the growth in insolvencies is very gradual, still relatively low in 2021, but continues growing progressively in 2022, 2023. And especially this is a scenario where economic growth would be slower, maybe reverting after 2022 to the more sluggish rhythms that we saw prior to the pandemic. the productivity does not increase. There is no structural transformation in the economy, or not as much as we would like after 2022. So we will still have to monitor insolvency data as they continue to come out during the year to see which of these two scenarios materializes. And that will tell us a lot about how well these economies can perform in the future. So with this, we end the presentation, and we give the floor to the Q&A session. And any questions that we don't get to here, you can email them to us, and we will do the best to address them. Thank you very much.
Thank you, Marcos. Thank you, Seltem. I really want to thank you for this important economic update. A lot of information, risk, and the opportunity, I will say. As Marcos said, now it's time for the question. You can submit via portal. I will start with one with Seltem. Today we have in Israel election, so really we are in the moment. How do you think this political election can assess or can affect the Israel economy?
Well, actually, as you know, Israel will recently had experienced important number of elections. So, well, none of them actually have changed too much the economic outlook of the country. So the Israeli political system allows too many parties to represent themselves in the elections, and there can be an important number of fragmentation in the parliament. However, we haven't seen any negative impact resulting from this political outlook coming into the economy. So Israel economy is one of the strongest in the region, with the risks of the sectors really under control, and especially for the ICT sector and pharmaceuticals and agri-food, taking advantage of the pandemic conditions. The country's international reserves remain quite high, with a negligible level of inflation. So we expect the Central Bank of Israel to continue to keep its policy rate at very low level, which would also help the improvement of the business environment in the country. Thanks to the recent improvement in the relations with the neighboring countries, we expect a higher number of business and investment opportunities to be open up for Israel, and we consider that the country will be able to take this opportunity and increase its investments across the region. And also it will benefit from a higher number of tourist inflows coming from those countries. But of course, it will partly depend on the health conditions. But all in all, we are optimistic on the Israel economy.
Good news. So I go to Marcos, and I think also this topic will regard Turkey. But before I start with Marcos, is inflation coming back to Eurozone? The economy will start when the pandemic and the vaccination will be more widely diffused. What do you think are the implications of the growing of inflations?
Yes, thank you. Very interesting question. So after a long time where inflation was kind of out of the picture for the Eurozone and for the world economy at large, at least for advanced economies, we are seeing the return of these inflationary pressures, most notably in the United States, very related to the huge stimulus being implemented by the Biden administration, but also to a lesser extent in the Eurozone. So to some degree, this is good news because in recent years, the most difficult problem for the European Central Bank has been deflation, getting closer to the 2% target, and I would say that to the extent that inflation poses risk, there are risks that are not there already. Because even though inflation is coming back, we're still very far away from getting close to the 2% target of the European Central Bank. As evidenced by the recent decision of the ECB to expand to increase the pace of its bond buying program, they are very far from worrying about this at the moment. With this being said, during the rest of the year, I think there are some things that you have to keep in mind, because inflation can have some, let's say, unexpected effects if and when it gets above the 2% targets. So, and especially one that I think is not talked about enough is the relationship between inflation and sovereign bond yields. And this is important because, as we know, there is the levels of public debt are very high in Southern European countries. Now, this has not been considered a problem recently, basically because of the fact that debt service costs, meaning what the cost of the interest that governments pay on that debt, are very low. But what happens? We know that bond yields, the risk premium on bond yields are related to inflation. When there is inflation, bond yields increase. And also, moreover, if we are in a scenario where inflation is above the 2% target, then that's the situation where the ECB might feel tempted to raise rates if it wants to remain loyal to its price stability mandate. Like I said, we are not there yet. We are not there yet. But if we get to that point, then the ECB will be in a relatively difficult situation when it has to choose between price stability and financial stability.
Thank you. I heard that Draghi said that maybe we have to reconsider the way we consider the debt. So maybe it will happen also in Europe.
Yeah, big question.
Yeah, big question. For Seltem, we have this news on the removal of the central bank's chief. How do you expect that these latest changes in Turkey will affect the Turkey macroeconomic vulnerabilities and also the lira that is also affected by this? Thank you.
Yeah, the first reaction of the market has been was a huge sell-off of the Turkish assets, not only the Turkish lira, but all the Turkish denominated assets. But with the opening of the Turkish markets on Monday morning, we saw that this huge sell-off has started to ease. But of course, this decision, this unpredictability actually of the monetary policy framework creates some concerns in the eyes of the international investors. So even though the market participants can push for another policy rate hike for the next policy meeting on April 15th, I think that the decision, the recent removal has kind of took off the table and another rate hike cycle, unless there is another huge sell-off of the Turkish lira. But of course, as I said during the presentation, the new governor's commitment to lower the inflation and to not change the policy stance of the bank is an assuring thing for the market participants. However, of course, these kind of sudden changes can create some concerns when international investors try to make their investment decisions. So two sources of economic imbalances this can create. The first one, because of the recent sell-off, this removal can push Turkish residents to increase their dollar holdings. And the second one is that if the lira continues to depreciate further, it can make more difficult for the country to meet its external debt obligation. I mean, Turkey has a very good historical record on paying its debts. So in that sense, I don't think that the country will have a problem, but the rolling over this external debt will be just more expensive because of the depreciation of the lira.
Thank you, very exhaustive. Marcos, regarding the global recovery, we have China and USA that are in the radar. Do you think they will have a special role in boosting the recovery and the global economy?
Of course, I mean, the United States and China are the two economic engines of the world, and earlier in my presentation I was talking about the recovery in manufacturing. Well, for Europe, a lot of that has to do with the recovery in China, because we know that European manufacturing is a very integrated machine, and notably. One of the reasons why Italian manufacturing, for instance, has been doing so well is because German manufacturing has been doing so well. And that in turn is because, well, German exports have been doing so well because global trade, not only because of this early recovery in China, has been improving pretty fast. So I would say that, of course, be it the stimulus in the U.S. Or the kick up in the Chinese recovery are immediately very good. There is a possibility for having too much of a good thing, though, if and when the recoveries of the global trade and the global economy become too divergent from the European economy, meaning that there will be a risk if, let's say, Europe starts lagging behind by too much. For example, because the vaccinations are taking exceptionally slow time. Now, why would this be a risk? Well, think about what is going on with the rising prices of certain commodities, with the rising prices of income of inputs, with the shortages in semiconductors, the shortages the shortages in shipping containers and things like this. If the global economy is recovering way faster than the European economy, then all these prices continue to go up, but demand in the internal European market lags a little bit behind. Now, for the moment, this is not being a problem because this divergence is not strong enough. Because it's not being a problem because European manufacturing firms in concerned sectors like plastics or metals are being able to transfer these rising prices of inputs to their seller prices, meaning that the rising prices of income are not translating into pressures on margins. But if at some point the internal European economy is lagging behind the global recovery, that could be a problem. But overall, a better, more healthy global economy, a better, healthier recovery in global trade is, of course, good for the European economy and for the European exports especially.
Thank you, Marcos. One topic regarding tourism. Everyone would love to start again to travel. But how do you think this sector will be affected, and as is an important factor for our economy? The Middle East, Italy, Spain, Greece. So now is really affected. What do you think will be the trend? Who wants to answer?
You want to go at it?
Just for Turkey and the Middle East part, if you want.
Yeah.
Well, I think that for the vaccination process and the further possible increases in the number of daily cases will be determinant. However, it's a very good thing for example, for the United Arab Emirates and Israel to be among the countries in the world having the best performance of the vaccination. Well, Turkey also is doing good in this sense. So I think that if European countries and also in the other countries that are sending the most more tourists to those destinations, I mean to Turkey and the Middle East countries, if the level of vaccination is increasing, that will support the chances of attracting a higher number of tourist inflows for the countries in the Middle East and Turkey. But so in this sense, the vaccination inside of the countries, but also outside of the countries will be important. But currently, we see that there are some disruptions in the vaccine supply chains. So if this continues, of course, this would slow down the vaccination efforts. However, if the producer companies are able to increase their production levels of vaccines, this will accelerate the outlook for tourism and things can start going back to normal towards the end of the year. But of course, again, this will be depending on the vaccination and the health conditions.
Thank you, Seltem. Marcos?
Yes. Well, for the case of Southern Europe, it's not looking like we will be able to have a completely restriction-free summer. It will be a summer with a much better performance than the last one, I think, but not completely back to normal. I would say that that still, like I said during the presentation, though a lot of firms have been saved, there will be some pain in this sector, and also because of the fact that well, there will be some degree of structural change to how to let's say the composition of tourism consumption, to how exactly we travel. And for instance, this might have some implications in the transport area of tourism. I've been reading that one of the reasons why we are having a strong recovery in the automotive sector, for instance, is that there is increased demand for rental cars. So people are increasingly preferring that kind of renting a car for a road trip instead of taking trains and taking planes, and this might have a change in consumer patterns that is a little bit outlasting of the pandemic. And of course, a change of consumer patterns will mean more demand for certain segments and less demand for others. Yeah, the better definitely than last year, but still, and even with all of the government aid, things could have been a lot worse, but not, we will not be completely back to normal.
Thank you very much. I will go for the last question, one for each one. One for Seltem. How do you expect the retail sector to be affected from the vaccination across the region you are following?
Well, the retail sector has been among the sectors that have been mostly hard hit during the pandemic. The easing of the lockdown measures will definitely help this sector to increase its sales. Actually, in the retail sector, we saw a shift in terms of sale channels because of the brick and mortar stores have been closed during the pandemic. The most of the sales has been held through the online channels, but the companies had to pay to meet their fixed costs, such as rents and staff wages. So actually the closing of the brick and mortar stores during this pandemic dragged down their sales, so their turnovers, but their costs didn't came down accordingly. That's why, even though there is a gradual opening of the stores, it will take time for the retailers to compensate the loss of the turnover during the pandemic in the rest of the year. So they will need more time, and they will have to operate with a weaker balance sheet because of the loss of an important part of their sales during the pandemic. They will need to operate with a negative working capital, and also in the upcoming period with an increasing rates on loans, their financing burden can also increase.
Thank you, Seltem. One last question for Marcos. Remote working is a reality in many companies around the world. So, for Europe, will remote working make our economies more productive, competitive? What is your opinion about?
Yes, this is one of the big, structural changes that will be significant with the pandemic. Most of the literature that has been made, that has been produced in the last few months about this topic gives two insights. One is that broadly, workers most workers enjoy at least some partial degree of working from home or working remotely, even and some of them even prefer to do this completely. Not all of them, of course. And two is that Europe, because they are countries with high qualification and a strong degree of knowledge economy firms relative to other more emerging countries, and also with an educated population, have a high amount of workers that can work remotely. And this is even the case for Southern European economies, even if they are not as rich in these teleworkable jobs as other economies more in the north of Europe. So on the one hand, yes, this can improve the productivity of many of these service sector firms, and even beyond that, an aspect that is less considered is the fact that, a lot of scholars have been saying actually many of these jobs that can be done from home can also be done from abroad. So I expect that we might see in coming years a lot of companies kind of outsourcing these more qualified jobs by hiring workers in emerging countries, and of course at a much lower cost of labor, which will undoubtedly increase the productivity of these firms. Now, this might have two effects if it takes a big enough scale. On the one hand, of course, these firms will be creating much more profit and can become very competitive in terms of exporting services to the world. But on the other hand, if it becomes pervasive enough, it will also exert downward pressure on wages of qualified workers in these countries, which will in turn be negative for internal demand. It is very difficult to say at this moment if this trend will be strong enough to have these macroeconomic effects, and if that is the case, which effect will be the stronger one. But it will definitely be something to keep in mind and to keep monitoring in the coming years.
Thank you. Very, very clear. I think now we can close our webinar. I really thank you, Seltem and Marcos, for their great presentation, and I thank you all of you for your participation again. One thing, you will receive the presentation of our Economist and the recorded version of the webinar. I invite all of you to follow us on social media on our website, because you can find the Coface publication and also the latest one prepared from Marcos. The title he presented during our webinar. The title is "The Business Insolvency Paradox in Europe, a Miracle and Mirage," or Mirage. And so follow us. We keep going on giving you economic update, and of course doing our job, our credit insurance, business information, bonds, and whatever. So thank you very much, and stay safe. We are not aware of this pandemic, but we will get over soon, we hope. Thank you very much.
Thank you.
Thanks, everyone. Have a good one.
Bye-bye.